The Sharpe Ratio, a risk-adjusted performance metric that tells you if your investment returns are worth the sleepless nights, like calculating whether that sketchy taco truck is worth the potential food poisoning based on how good the tacos actually taste. It was created in 1966 by Nobel Prize winner William Sharpe, who wanted to answer a simple question. Sure, your investment made money, but did it make enough money for the risk you took? Turns out, most people were terrible at this math, so he gave us a formula. Here's the problem it solves. Your buddy Brad brags about his 20% crypto gains while you made 8% in boring index funds. But Brad's portfolio swings up and down like a bipolar roller coaster, while yours moves like a gentle escalator. The Sharpe Ratio tells you who's actually the better investor. The formula is beautifully simple. Sharpe Ratio equals return minus risk-free rate, divided by the standard deviation. You take your investment's return, subtract what you could have made risk-free, like treasury bills, then divide by how volatile your investment was. Higher numbers mean better risk-adjusted returns. But here's where things get interesting. A Sharpe Ratio above 1 is considered good, above 2 is excellent, and above 3 means you either found the holy grail or your data is probably wrong. Most hedge funds would kill for a consistent 1.5. The risk-free rate is typically the 10-year treasury yield, basically what the government pays you to lend them money with zero chance of default. Not zero, but nearly zero. Standard deviation measures volatility, or how much your investment bounces around like a caffeinated day trader. Professional portfolio managers live and die by this metric. Warren Buffett's Berkshire Hathaway has a lifetime Sharpe Ratio around 0.8, which sounds low until you realize he's done it for 60 years. Meanwhile, that hot stock tip from your barber probably has a negative Sharpe Ratio. Here's a real example. Investment A returns 15% with 20% volatility. Investment B returns 10% with 8% volatility. If T-bills yield 3%, investment A has a Sharpe Ratio of 0.6, while investment B scores 0.875. The boring investment actually wins. You can calculate this for any investment: stocks, bonds, crypto, or your Pokemon card collection. Excel has built-in functions, or you can use online calculators. Most trading platforms now show Sharpe Ratios in their analytics. The catch? It assumes returns follow a normal distribution, which markets definitely don't. It also uses historical data to predict future performance, which is like using last year's weather to plan tomorrow's outfit. Plus, it can't account for black swan events that blow up your entire thesis. This has been the Sharpe Ratio explained fast. Now you can tell Brad his crypto gains aren't that impressive after accounting for risk. Remember, this isn't financial advice. Past performance doesn't predict future results, and you should diversify your portfolio beyond whatever's trending on X.